If you are feeling completely comfortable with everything, then you've got to expect lower returns.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Welcome to Two Traders. It's Walter here. Hello, Darren.
Afternoon, Walter.
So, Darren, today we're going to talk about this concept, this idea of, as a trader, how do you know when you've got it right? What does that mean? Like, how do you know? What does it feel like? Or what do you point to and say, yeah, okay, I've got it now? Or maybe, are you never really there?
Yeah, it's a good question, isn't it? And, I think when we start out trading, we kind of have this notion that when you have got it, you will know without certainty that you've got it. I think what you're kind of expecting is kind of a feeling that, when you're trading, you've constantly got this sort of internal battle going on where you're always, to an extent, questioning what you're doing or your strategy, because you're always seeing that, or if I'd just have had a different money management strategy there, I would have made more money. There's always better outcomes that you could have got. And I think we kind of have this notion that you're going to all of that's kind of going to go away, and there's going to be this kind of blissful calm, and where you're just trading, in a mechanical, almost like a sort of Zen Buddhist, or like a Jedi Knight, and it's all just kind of smooth. And I don't think that happens really. It certainly hasn't for me. But you just
You want to talk? I'm sorry, it's just so funny. You're right.
Yeah.
Go on, keep going.
Yeah, but you just kind of get to a point where you get better at knowing the elements that are worth worrying about and that are not, and you just you don't make so many bad reactions to the normal twos and fro's of a trading strategy. You don't react so badly to losers. And things like that. There's a really good quote by Mario Andretti. Who have you heard of him? Mario.
Yeah,
Andretti,
the race car driver. Yeah. And he said that if you feel comfortable, you're not going fast enough. Or no, if you feel completely in control, you're not going fast enough. And I think that's the thing. If you ever get to the point where you're completely comfortable and at ease, and you feel like you've got it, then even if you're probably not pushing yourself enough. You're probably not performing to your optimal, so you get more used to the pain of trading, and you get better at dealing with it. But I don't think you do ever know for sure that you've got it. Yeah, it's a fair point. I the only reason I was chuckling was because I agree. I think what changes, and I think why we don't feel like we haven't really got it or reached it or hit the spot, is because we're always moving the goalposts. You know what I mean? Like so like in the beginning, I think, like thinking back, I thought that, and I think this is very common, I don't think I'm unique in this aspect, which is I thought that, if you were a good trader, that meant you won more than you lost. So everything was on the win rate, and so I think what happens over time is your focus, or what you would define as successful or excellent trading or whatever. I think that kind of changes. And I think that's kind of, listening to what you were just saying, I think that's kind of how I interpret it. Maybe that's obviously my filter, my point of view. Like, for example, like right now you were talking about, like, you're in this blissful state of just, accepting whatever the market throws your way, I think that's one of those things it's one of those things that comes up, right? Like, first we want to be winners. We always want to win. We want to win more than we lose. Then maybe we want to be able to remove those crazy things that we do, like, letting a losing trade turning into a massive loser, or trying to extract revenge after we have some losing trades or whatever, and then later on you might think, well, I just want to be able to trade and not have to stay in front of the screen all night, and not get any sleep or whatever. Like, I guess what I'm saying is we define success in different ways as we advance as traders. And I suppose you would do that in life as well. Like what you would consider to be successful when you're 21 is probably going to be very different when you're 71, but I don't know.
Yeah. It's difficult as well, isn't it, to sort of, everyone's going to determine whether they've got it in a different way as well. I'm sure, most traders who kind of start trading something like martingale that have had 6 consecutive winning months and have got a beautiful looking equity curve will imagine that they have got it. I suppose really all you can ever get is good probabilities of longevity, and that's kind of all you really should be aiming for. Although, again, what people want to get out of trading varies massively as well,
Yeah, so so let me ask you something. So have you ever traded martingale before? Did you ever trade that?
No, I've never been drawn to it because it instantly appears to be wrong to me.
Yeah.
And instinctively when I came to trading, win rate was never something that was like a lure for me. So no, martingale never appealed to me.
Yeah, I was talking to I don't know what you would call him, like a performance coach or whatever. And he was talking about trading, and I was explaining to him what traders go through and stuff like that. And he made this offhanded comment, like, as long as you win more often than you lose. And I think that's kind of the assumption, is that if you're a trader, you just win more often than you lose. So it's interesting that I think I've talked about the story when I was at university. My friend, a good friend of mine, who actually ended up getting me into trading later on in life, he was basically running like a martingale strategy with blackjack, and he would walk around with he had like 7 blackjack, 7 card decks that he carried around with him, and he was always playing blackjack by himself, right? Like with himself. And he was trying to work out, I guess it's sort of a caveman style of Monte Carlo study, where he was trying to work out how many consecutive losers would he have. And then we went to our statistics professor and we said, what about this? And he looked at us like we were crazy. He's like, that's the gambler's fallacy, which is the bedrock of martingale. The gambler's fallacy being, of course, this idea that if you have so many results of something, then the other side is more likely to happen. So that's why they have in roulette tables, they'll have a lot of casinos, they'll have the numbers that have come up. So you can look up there and you can say, oh, well, it's landed on red, 10 times in a row. It's definitely going to land on black next time. Well, not really, but yeah. So that's so you were never drawn to that. That's interesting. So you just thought that's just not going to work. Yeah.
I think, when I first got into trading, the first thing that clicked with me was the idea that, the simple sort of cornerstone of, if you win more on your winners than you do on your losers, then you don't have to win that often. And that just instantly made sense to me. That was the one idea that's always made sense to me. And that's probably why it's still like the most important part of my trading. But then, when you go on from that, you realise, well, that isn't the only way to make money. And it's kind of that, I think, when you say when you've got it, I think it's a case of like understanding what the probabilities are. That's what it means. If you understand the probabilities, then you stand a good chance of making some money consistently. If you think about something like the Market Wizards book, not all of those traders in the Market Wizards have had continued success since they were in those books. Some of them have gone on to lose a lot of money. They've not all continued, and I imagine all of them, we would assume, had got it, So there's never that certainty.
I agree. And you bring up exactly what my next question was, well, what is the thing that you would hang your hat on and say, well, that means you've got it? And you just mentioned probabilities and understanding probabilities. Well, to me, the thing that I've been working on a lot is trying to let go and trying to understand that it's okay whatever happens. So in other words, let me explain it in a better way. I guess to me as a trader, I don't want to say you've got it, but it's something like that. You're doing well when you're at the point where you keep chopping wood no matter what's happened. So in other words, like if I'm trading a really low win rate strategy, I have to be okay with the fact that I might only win 22% of the time. if my math is right, 78% of the time I'm losing, right? 78% of the time I'm losing. So to me, you've got it when you're able to keep taking the trades without second guessing yourself when you know you're only going to win 2 out of 10.
And I find that in the end, when you've done that for a while, I find that more comfortable to do than thinking I've got a 78% win rate, so really I should be winning every trade. That for me is, I know essentially they're sort of two sides of the same coin, really, but I certainly find that easier because, whenever I enter a trade, I'm pretty much expecting it to lose. And then when you get a winner, it's like, oh, well, that was nice. And it was massive as well, which is even better.
Yes. You would make you've heard about the study about how the Danes are the happiest people in the world.
Yeah.
And the reason why is because they've got low expectations.
Yeah. And, that's important. And they need to be realistic expectations as well.
But I mean, that's what that sounds like, when you say, I'm going to go ahead and take this trade. It's probably going to be your loser. And then, that was surprising.
Yeah. Yeah.
It worked out all right. Yeah.
Yeah. It's how you kind of reframe it and look at what you're really trying to achieve. If you've only got hit one winner out of 10 trades, you're just luck can get you there. If you hit 2 winners out of 10 trades and you're making big profit, then that's kind of an easy burden to trade with. But I know for a lot of people it's the complete opposite they prefer to do. But I think also when people think about a state where they believe they've got it and that they can finally relax about trading, I think deep down psychologically what they're looking for is a state of no uncertainty. So this is my strategy, it works, it makes a lot of profit, and it's always going to work. We kind of want uncertainty on all of the levels, and then okay, we've got it now. But again, that's just unrealistic. If you listen to the traders who've been around for a long time and the market wizards, they're always refining, they're always tweaking, they're always looking at new models, and they're completely at ease with the fact that they could trade some market condition for a long period of time and then something could change, which means that particular model doesn't work anymore. But they get that deep understanding about probabilities and the fact that there's a lot of opportunity in trading, and just because a certain model stops working, then it doesn't mean you're not going to be able to find a new one. It's about mindset and where you believe edges really are in the market. And I think some of us think, there's like just a particular equation that works and that's going to work forever. And that's just not how it is. I don't believe it is anyway.
What I'd like to know, Darren, is why do you think it is that these traders, such as the market wizards or you or me or whoever, the listener here, is interested in validating new models or tweaking models? Is it because the markets always change and you must do that to stay ahead of the curve? Or is it just because trading is interesting to you or I or whomever, and that's why we like to fiddle around with trading systems?
Yeah, I think it's just human curiosity as much as anything.
Agreed. Yeah.
I think they just enjoy doing it, don't they?
Exactly.
They enjoy looking for these little, look, a Friday close on the S&P 500, and if I enter there, and I think as much it's as much for curiosity as anything, and the fact they enjoy it. I think all of those traders, let's keep talking about the market wizards. I think if you went to all of them and said, can you trade a random entry and make profit, they'd all agree, and they'd all be able to give you a good explanation why. So I think they all have a fairly deep understanding of probabilities to do that. And then with those looking for models that work, they're just looking for a little edge to kind of use that probability model in, and again, some of those things can just be for psychological reasons as well. I'm currently trading this trend trading strategy where you use something to indicate the long-term trend, and then you go to a lower time frame to enter in the direction of that trend. And the interesting thing is, if I completely take the long-term trend element away, it makes more money. But when you come to trade it manually, psychologically is way more challenging. So I actually trade it with this long-term trend indicator in place, knowing that it doesn't actually add any edge. It actually means I make less profit. But every day that I get up and trade, it's just easier for me to do.
Yeah, that's like having a target and having a trailing exit on the same trade, splitting your position. You actually will make more money if everything is set to the trailing exit because you have an unlimited profit potential. But psychologically, I know it's easier to handle having a trade split that way. So that's why I do it. So it's the same thing. Yeah.
Yeah. So, you could argue that looking for technical models, edges in the market is more of a psychological thing than anything. I think those edges are so slim. They're slim, those edges. It's the other elements that are going to really pay dividends.
Absolutely. And I think that's probably, you were hinting at some of the market wizards, how they had changed or become, lost millions and, bowed out of trading or whatever. And I believe that part of it may just be that they were unable to withstand the drawdown. So I'm thinking specifically about Richard Dennis. Now, Richard Dennis, who was, along with William Eckhard, the guys that put together the famous turtle experiment with the turtles, and they're interviewed in the Market Wizards books as well. I think my understanding is that years after the first Market Wizards book, Richard Dennis was in a horrible drawdown, and he had lost a lot of investors and this sort of thing. And I remember reading an interview where he was saying, well, we had cracked, basically, yes, we've had some drawdowns, and we realized that a lot of people are trading the end of day trend trading system like we are. So what we've decided is that you need to move to a different time frame. You need to go either really, really lower time frame or really, really high time frame, but the daily one wasn't really working anymore. So basically what he was doing, he was switching his strategy up. Now, I contend that he probably, one of two things was happening. Either psychologically, they couldn't handle having that drawdown, that extended drawdown, and all their clients pulling their money out, and or they had too much risk on, so that made the drawdown worse than it should have been. And instead, if they probably have just kept chipping away, they probably would have pulled out of it, but maybe they're just unable to withstand that psychologically, which is kind of what I was talking about before, about the big thing that I'm working on is being able to keep chipping away even though you're going to lose. The most likely event is it's a loser. So what do you think about that? Do you think that that's a possibility? Because every time I think of Richard Dennis, I think I can't help but think that maybe that's what was going on there. He just couldn't handle it psychologically, and so he's looking for a reason, and he was grasping for that, and the reason was, oh, well, the markets have changed, and so how do you know it wasn't just a normal sort of an extended deep drawdown?
Yeah, his pain from making hold, basically, and that was making the decision for him. And I've seen that myself, like the versions of my strategy that really make amazing returns, the pain threshold is too much, and I find that a lot of the rules that I put in place are just to sort of deal with that pain rather than there being any great technical advantage in them. Yeah, I think that's definitely, and especially if you've got clients that you're trading for and they're pulling out, that's going to take a psychological impact on you as well, isn't it?
Yeah, and isn't it interesting, the guy from The Big Short, was it Barry? Was that his name, Dr. Barry? Yeah. Because he was so convinced that he was right. Even though he was in a deep drawdown, and even though his clients were threatening to sue him and pull their money out and blah, blah, blah. Burry, that's right. Yeah, Michael Burry. He was so steadfast. And that could be, both ways. That can be one of those things where you should be somewhat humble because the market can definitely eat away at your account for a long, long time, no matter how steadfast you are in your position. So that's not necessarily maybe the best way to approach it, but that's the way he did. And it was very different. To me, that was a very different approach to what Dennis took. Now, I don't know how many years or how long Dennis was in drawdown before he decided to switch up his strategy. And maybe he was going to do it anyway. I don't know. But it's interesting to me that he sort of succumbed to the pressure, and Michael Burry didn't.
Yeah, I know. And I notice this with fund managers. They kind of either go one way or the other. And Dunn, he says to his investors, I'm not going to explain anything. I'm doing it this way, and if you don't like it, take your money out. And incidentally, he doesn't have a great many investors, even though his returns are really good. And then you get someone like Tom Basso, who says that he listens to what his clients want, and that for him, that is his job as a fund manager, to give his clients what they want. And he has much more modest returns, but tends to go through less pain. And I think as individual traders, we have to that's a difficult decision that we have to make, really. Do we want very little pain? Then you're going to get modest returns, and if you're prepared to sit through much more pain and bigger drawdowns, then you're in a better chance of getting those big returns. And I think sometimes we kind of want to be in both camps, and that is probably the worst place to be. You either you want to be in one or the other.
Okay, unfortunately, that's all the time we have for this episode, but in part 2, you'll hear Darren talk about the importance of pain in your trading. You'll also get the lesson of the 43 million trades and how you can use that lesson to improve your trading. All about the big 5 and why neurotic traders have an advantage, so that's a little bit of psychology there. Also, why traders diversify. Darren talks about this. And the two traders talk about one of the easiest ways to create an edge in your own trading. All of this and more in part 2. See you next time.